Today we'll be discussing a 2026 market outlook and featuring Dylan Lull with Capital Group. You can expect Dylan to have the floor for about 45 minutes, and we'll conduct a short Q&A at the end of the webinar. The webinar will be recorded. If you have any questions during the webinar, just type the questions into the chat window and we'll address them at the end during our Q&A session. Without any further ado, I will turn it over to Dylan.
Thank you, Lisa. I greatly appreciate your introduction. I'm just going to go ahead and share my screen. And Lisa, if you don't mind just letting me know in a second here if that pulls up, I would appreciate it.
Dylan, I do see your screen. I think you're good to go.
Awesome. Well, thank you, Lisa. Again, I appreciate the introduction. Good evening, everyone, and thank you so much for having me today. As Lisa mentioned, my name is Dylan Lull, and I am a wealth management consultant with Capital Group, home of American Funds. It is my privilege tonight to be with all of you to share Capital Group's perspective on 2026 and beyond. As Lisa mentioned, I'll take 45 minutes on the front end. We'll then open it up to Q&A. In order to give you some context on just who it is you're hearing from today, I thought I'd give a quick introduction to the organization, Capital Group. So Capital Group, in partnership with firms like Harbor Investments, has been managing money on behalf of investors since 1931. Lisa shared the WDS mission. Our mission at Capital Group is very simple. It is to improve the lives of investors through successful investing. To that extent, a few things that we believe in, foundations organizationally. Number one, we believe in active management. So Capital Group is the world's largest active manager, meaning we do not buy the entire stock market and then hope that it continues to go up. In our opinion, hope is not much of a strategy. Secondly, instead, we believe in fundamental research, which I believe is one of our greatest advantages and differentiators at Capital Group. We have nearly 500 investment professionals spread across the globe that collectively did more than 20,000 in-person research visits with companies in 2025, trying to decipher which investments we felt were attractive, what we wanted to own inside of our investments. So a very rigorous fundamental research process. And then finally, and most importantly, we do believe in the critical role that a financial advisor plays in helping navigate clients to better outcomes. So I have personally had the pleasure of knowing Lisa for somewhere between 15 and 20 years and working with the wealth distribution team for the last decade. And I can attest firsthand that everyone in this room is benefiting from their collective experience, expertise, and we truly value the role that an advisor plays. So thank you to the team for coordinating tonight's event, and thank you for having me. From an agenda standpoint, three things that I'd like to cover. First, we will give some perspective, not predictions, but again, perspective on where we've been, where we are today. Most interestingly, as we think forward to 2026, our outlook and why we remain optimistic. Secondly, we're going to try to give you some confidence as investors. I know we all live in a 24/7 news cycle. The news is overwhelmingly negative. We're going to try to shine some lights on things that give us confidence and optimism. And then finally, we'll talk about opportunities. Now, I don't want these to be confused with investment recommendations. I don't know any of you on the call, but we will talk at a higher level about things that excite us that we believe are creating attractive long-term investment opportunities for investors as we go into the future. But before I dive in, I'm going to actually start with a quick story that is actually 100% unrelated to investing or the economy. If anybody was on this call last year in January where I spoke, you will notice a bit of a trend. Last year when I kicked it off, I spoke about marshmallows and the marshmallow study. I always like to try to kickstart these meetings with stories that at the beginning feel entirely unrelated, but do have some shared parallels or commonalities with what it takes to being a successful investor. So if we were in a room together, I'd ask you to raise your hands, but kind of a question for the audience. Has anyone heard the name Trudy Etterly or seen the movie The Young Woman in the Sea? That was a movie that Disney published back in 2024 that chronicled the lifetime accomplishments of Trudy Etterly. Now, Trudy was a world champion swimmer back in the 1920s. And Trudy set a very audacious goal. Trudy wanted to be just the sixth person and the first woman to ever successfully swim across the English Channel. Now, Trudy, going into this, knew that there were challenges that she was going to face. Just like we as investors know that there's always a challenge on the horizon, something that should get us a bit uncomfortable. But what I love about Trudy's story is it is a story about persistence. It's a story about careful planning, the benefits of being innovative and willing to adjust along the way. And then finally, it's a story about the important role that a coach can play in getting us to better outcomes. So by 1924, Trudy was an Olympic gold medalist. She had set and held multiple world records. She was an incredibly accomplished swimmer when she took on the challenge of trying to swim across the English Channel. And in August of 1925, Trudy stepped into the water off the French coastline and began the 21-mile swim to England. And on her first attempt in 1925, Trudy was unsuccessful. She failed on her first attempt. As I said, it's a story about persistence. If she was successful on the first attempt, I bet Disney never makes a movie about Trudy Etterly. She was clearly disappointed, but she was not deterred. Trudy lived in New York. She returned back to New York. She hired a new coach, one who had actually successfully swam the channel himself a few years prior. And then a year later, in 1926, Trudy again returned to the French coastline, got into the water, and started her swim. But importantly, in 1926, Trudy did not swim 21 miles straight across the English Channel. She took a very different path, and she took a route that accounted for the ever-changing tides and currents that you face when you're swimming in the open water. But collectively, on that day in 1926, Trudy Etterly swam 35 miles, not just 21. Now, Trudy knew that there were going to be challenges as she went through her swim. Notably, it was going to be cold, even though it was in August. This was prior to wetsuits being invented, and that is a large body of water. She knew that she would be utterly exhausted trying to take on a 35-mile swim. She knew that a portion of her swim was going to be completed in the pitch black, in the dark. And then she knew that there would be sea creatures, right? Trudy vividly recalled the sensation of jellyfish stinging her arms and her legs as she swam across the channel. But in 1926, Trudy Etterly successfully weathered all of those challenges. She came ashore in Dover, England in 14 hours and 31 minutes. Most importantly, Trudy Etterly swam the English Channel more than 2 hours faster than any man had successfully completed it while going 35 miles instead of 21. So again, this is a 100-year-old story about swimming, not the stock market or the economy. But I said at the beginning, many of the same characteristics that led to Trudy's success also apply to us in 2026 about what I believe it takes to be successful as an investor. A bit of persistence, careful planning, a willingness to adapt, right? And then finally, the benefit of having a good coach in our corner. And again, everyone working with WDS, in my opinion, has a tremendous coach in their corner. So I'll dive into the outlook. I'm going to start Kind of the first few slides are going to be more at a macroeconomic level. From there, we'll kind of shift into equities or the stock market. And then we'll wrap up with a few slides on fixed income. So as we think about the year ahead, Capital Group and American Funds, we are calling for improved economic stability in the year ahead. That outlook is driven by strong fundamentals illustrated on this slide through a number of economic indicators. That's a fancy way of saying what we're putting on this slide is Capital Group's views across a number of indicators, and the majority of them are positive. So notably, the first three columns on the left, we are forecasting resilient global economic growth in 2026. Notably, though, we are also calling for a convergence of growth rates, meaning different regions around the world, in our opinion, will be growing at more similar rates in 2025 than they may have for the past decade. Notably, 10 years ago, the United States grew twice as fast as Europe. And again, in 2026, we see those growth rates converging through a slight slowing of growth in the US and an acceleration of growth outside of the US. In the center of the page, we'll see Fed policy. In our opinion, that is another positive for investors. That is another tailwind that we are likely facing this year, is that we will have a new Fed chairperson this spring, regardless of who that individual is. We believe that they will take a more dovish approach, and they are more likely to continue to cut interest rates. So interest rates have obviously come down here over the last 18 months as the Fed has continued to cut rates. We think that continues with 1 to 2 more rate cuts in 2026. Second to the right, we show inflation. In my opinion, this is potentially one risk that Capital Group is potentially seeing a bit more elevated than what the market is pricing in today. You'll notice the industry or market consensus is for inflation of 2.6%. We see that potentially higher at 3 to 3.3. And then finally, on the right-hand side, we think that the US dollar is likely to continue to weaken in 2026. The US dollar did weaken relative to other currencies last year. We see a continuation in 2026, just not to the same magnitude that the dollar weakened last year. Another page, in my opinion, that screams a lot of positives that we see. This is a slide illustrating improving fiscal and monetary policy, broken down by different regions of the world, right? So if we look at the left-hand side at the United States as an example, easier money, lower interest rates, tax reform, we believe that is going to be very powerful. They are forecasting there will be $200 billion in tax refunds issued here in the first quarter or second quarter in April. Deregulation tends to be a net positive from an economic standpoint. The One Big Beautiful Bill, which was officially passed last July, in our opinion, will increase economic growth or GDP by 0.5%. If we look overseas in Europe, meaningful fiscal stimulus taking place in Europe for the first time in a very long time, as Germany announced last year a 500 billion euro stimulus package centered around infrastructure and defense, right? As well as increased NATO defense spending that we believe helped stimulate those economies. And then finally, on the right-hand side of the page in Asia, we continue to see positive corporate reform in areas like Japan and China, as well as an overall stabilization of the Chinese economy. So again, fiscal, monetary policy, a lot of positives that we see for the year ahead. I mentioned 2 slides ago that our belief is the Fed is likely to continue to lower interest rates in 2026. This slide looks at different time periods when the Fed was cutting interest rates, and then it separates them into 2 different categories. The first category being time periods where the Fed was cutting interest rates and we were in a recession. So 80% of the time that the Fed increases interest rates, they either increase them too high or keep them elevated for too long, and we end up tipping into a recession. Those higher interest rates are restrictive, they slow economic growth, we enter a recession, and then the Fed starts to cut. The other 20% of the time, which we believe we're in that camp today, the Fed successfully increases interest rates. They killed inflation, which was their ultimate goal. And then they start to cut interest rates without the economy going into a recession. So Capital Group squarely believes that we are on the left-hand side of this page in 2026. And what this chart shows you is that stock and bond returns have historically been very strong in non-recessionary cutting cycles. Now, again, we think back to the first time that the Federal Reserve cut interest rates in this cycle, it was all the way back in September of 2024, so about 18 months ago. Since the Fed first cut interest rates in September of 2024, the US stock market is up roughly 30%, right? So returns have been very strong. And again, this slide shows us that historically that is what we should have expected. This slide, we can kind of make some jokes about, especially on the right-hand side. But if you look at the left-hand side, one of the positives that we see here is that policy uncertainty is diminished relative to where it was 10 or 11 months ago. If we think back to Liberation Day in April of 2025, policy uncertainty skyrocketed, which is what you see on the right-hand side. In April, we've all heard the saying that the stock market dislikes uncertainty. And as policy uncertainty increased, stocks fell pretty dramatically. Since April of last year, policy uncertainty has been moving lower, which obviously markets have responded favorably to. But my joke here is simply, well, that's where we are today. We never know where we might be tomorrow. I feel like policy uncertainty is something that can change pretty quickly in a blink of an eye. But just noteworthy that, yes, markets dislike uncertainty. And when we saw a spike in uncertainty last year, we saw a correlating decline in the equity markets. In terms of potential headwinds, we've shared a lot of positive outlook and good news here. What are the few things that we believe we as investors need to be mindful of in 2026? On the left-hand side, we are illustrating that the stock market today is absolutely on the expensive side of average from a historical standpoint. So 3 things that I would try to draw your attention to on the left, those light blue diamonds illustrate the current PE ratios, that is price to earnings of stocks across 5 different regions of the world. Think of that simply as how expensive is the market. A higher PE ratio means we're paying more to own those stocks today. So the light blue diamond is where we are currently. The trailing 10-year range of valuations would be the darker green bars. And then the dark colored dash is the 10-year average PE ratio for each one of those regions. Now, regardless of which region your eyes went to first, across the board, what you will notice is that the current valuations or the current PE ratios are near the tops of those 10-year ranges. And in every instance, they are above that 10-year average number. So yes, markets are a bit more expensive today, but that is also the result of the fact that we have been rewarded as investors with very strong returns for the last 3 years. So the S&P 500, which tracks the 500 largest US stocks in the US, is up 86% over the last 3 years. Right? It was up 18% last year. If you look at the other 4 regions, Japan, ACWI US, which is global markets minus the US, Europe, and emerging markets, those 4 regions are all up anywhere from 58 to 62% over the last 3 years. But ultimately, what is it that drives markets over long periods of time? It's earnings. And simply the question of, can companies generate and grow earnings over time? Is earnings growth is the number one driver of market returns. So as we look, what we're forecasting for 2026 is another strong year for global earnings growth. On the low end, Japan forecasted to grow earnings at nearly 9% this year over year. On the high end, the emerging markets at 17%. So again, from a macro standpoint, a few slides, a lot of positives. We'll go ahead and transition into the equity markets. The first slide here really helps to reinforce Capital's strong belief that equity market leadership is going to continue to broaden. Over the last few years, you've probably seen headlines about the Magnificent Seven stocks. Those are 7 stocks that are essentially large cap tech companies that have driven a majority of the market's return. One thing that was very important in 2025 was it was the first year in many years where we saw outperformance from non-US stocks compared to both the S&P 500 as well as the Magnificent Seven. We think that equity leadership is going to continue to broaden. What we also illustrate on the left-hand side, again, PE ratios. Europe was up over 30% last year, but we are only paying 15 times earnings compared to the Mag 7, which was up 22% last year. But those valuations, again, higher numbers, more expensive, 42 times earnings. I think another thing that is important to point out is we have seen a bit of a dispersion, specifically within the Magnificent Seven stocks. So if we go back 3 years ago to 2023, all 7 of those stocks outperformed the S&P 500. If you bought any of those 7, you did phenomenally well as an investor. In 2024, 6 out of the 7 outpaced the S&P 500. In 2025, only 2 of the Magnificent Seven stocks delivered a higher return than the S&P 500. The 2 stocks last year were NVIDIA and Google. Google was the top performing Mag 7 stock. It was up 65%. On the low end, Amazon was the laggard at just a 5% return last year. On the right-hand side, we show that breadth in the market is continuing to improve. Again, more companies are doing better, which we believe is a very positive and bullish indicator. So the right-hand side shows the percentage of S&P 500 stocks that are currently trading above their 200-day moving average. So companies that are experiencing positive price momentum and increasing. If we go back to Liberation Day of last year, that was at a low level of just 17%. That number has continued to increase since April of last year. As we sit here today, 67% of the S&P 500 stocks are currently trading above that 200-day moving average, illustrating that momentum is widespread across industries. It isn't just 7 tech stocks anymore. Which brings us to tech and AI. And I would say that there were no shortage of headlines in 2025 that were trying to create parallels or draw comparisons between our current market environment and the dot-com bubble or the tech bubble of the late 90s and early 2000s. So while there was a lot of headlines on this topic, I will tell you that the investment professionals at Capital Group feel that this time it is entirely different. And I think that this chart really helps to illustrate why we view it as being a different environment. So the left-hand side is the dot-com era. We show the return of 4 mega cap tech stocks from the late 90s. These were stocks that were driving euphoria over internet-related companies that helped fuel the dot-com bubble. Those 4 companies at the time were referred to as the 4 horsemen. Those four companies being Microsoft, Cisco, Intel, and Dell. The green line represents the combined market cap, or the price of those four stocks. The blue line represents the earnings that those companies were generating. Now, in hindsight, this is incredibly clear. There was a bubble. There was a massive disconnect between the price and the earnings. On the right-hand side, we look back over the last 5 years, and we look at the Mag 7 stocks minus Tesla, and we introduce a company called Broadcom. Broadcom is a leading designer of semiconductor chips. We believe those 7 stocks are 7 of the largest AI exposed companies. Their combined market cap is listed in green. The earnings of those 7 companies are listed in blue. So again, the environment that we're in today looks entirely different, where the price appreciation that we've seen in markets has been driven by earnings, not speculation like the late 90s. As we think about AI, we believe that the potential winners are essentially limitless, and it is significantly broader than just the companies that produce semiconductor chips. I would think about this slide through the lens of 1.0 on the left, 2.0 in the center, and 3.0 on the right. Now, I would argue the publicly traded names on the left-hand side within the AI tech stack have had simply parabolic returns over the last few years. Companies like NVIDIA, companies like Broadcom, companies like Taiwan Semiconductor. If you were to try to name who are the companies that are poised to benefit from artificial intelligence, those are rightfully the first names that come to mind. But at Capital Group, again, we think the beneficiaries are significantly broader. If we go to the center of the page and we look at those 2.0 beneficiaries, those are the companies that you'll find in the industrials sector, utilities, materials, the companies that are a prerequisite or a necessity to building out the data centers that are happening around the country that are continuing to benefit. I'd highlight a company like Constellation Energy in the center of the page. Constellation Energy is the largest independent owner of nuclear power plants in the world. And Constellation Energy has formed a partnership with Microsoft to use Constellation Energy to source electricity for their data centers. We own a lot of shares of Constellation Energy at Capital Group, right? And they are that indirect or second tier beneficiary of AI. And then finally, on the third column, 3.0 beneficiaries, I would tell you that this is where our investment professionals today are spending all of their time. I mentioned they do over 20,000 in-person research visits with companies across the globe each year. They are sitting down with CEOs and CFOs, and they are looking at balance sheets and saying, we notice you're increasing your spend over the last 24 months on technology. Tell me about how you're thinking about leveraging AI to either improve productivity or improve profitability. And again, this is sector agnostic. This is industry agnostic. We illustrate 3 different sectors on this page. We call out a company like JP Morgan Chase, who has already realized over $2 billion in cost savings by leveraging AI to improve their operational efficiencies. So again, when we think of AI, it's massive. In our opinion, it is not a bubble. The analogy that I've heard our investment professionals share, many of which were managing money at Capital Group 30 years ago, they said if it inflates to a bubble, that is yet to be seen. But our current environment feels a lot more like 1995 than it does 1999. And what's important there, obviously, the market peaked 99, early 2000. So the analogy is that we have some room to run. An area of the markets that we continue to like on the equity front would be high quality dividend paying stocks. We see them as being attractive for a number of reasons. We've talked a bit this evening about valuations, and high quality, high dividend stocks today are trading at very attractive valuations and a meaningful discount to the broader market itself. Essentially, investors have fallen out of love with dividends as many people have started to chase growthier investments over the last few years. The second reason that we continue to like dividends in this type of a market environment is because historically they are meaningfully more resilient to the downside, right? These high quality companies that generate free cash flow tend to be more defensive in nature. They tend to provide us with better downside protection. That is what we illustrate on the left-hand side. Again, we went back to the tech bubble, March of 99 through March of 02. The NASDAQ is the dotted line at the top that goes straight up and then straight down. The S&P 500 is in the center. And then the S&P 500 Dividend Aristocrats Index is what's listed in the dark blue line. The Dividend Aristocrats Index, those are companies that have increased their dividend uninterrupted for at least 25 consecutive years. There's 69 companies today in that index. It's names like Coca-Cola, Johnson & Johnson, Caterpillar, McDonald's, those high quality companies that we believe help build in resilience during periods of uncertainty or stock market sell-offs. The right-hand side, we look at a trailing 20-year time period. We went month by month. We said we only want to see the months when it was tough to be an investor, the months in which the S&P 500 was negative. During those months in which the S&P 500 was negative, dividend stocks, as you see on the left, outpaced the S&P 500 by roughly 0.2% or 65 basis points each one of those months. Finally, on the equity front, I mentioned earlier that we anticipate the dollar is likely to continue to weaken throughout 2026. That was a very meaningful driver of the outperformance of non-US stocks in 2026, the weakening of the dollar. Again, our forecast is that the dollar weakens, just not to the same magnitude as it did last year. I also mentioned on the forefront that fiscal stimulus in Germany and other regions of Europe will absolutely be a tailwind in 2026. We break down Germany's stimulus package on the left-hand side, right across different areas and sectors, and then identify stocks that we believe could be positioned to benefit. So in the last few minutes here, I'll share a few fixed income slides, and then we'll go ahead and open it up to Q&A. When we think about fixed income, bonds had a very strong performance year in 2025. Our flagship bond fund is Bond Fund of America. That strategy was up close to 8% last year. And we see a scenario where that strength likely continues into 2026. The reason we feel that way is on the left-hand side, which is if you go and buy a bond fund, your starting income or the yield that that fund is paying today has a very high correlation to the outcome or the returns that that fund will generate for the next 5 years. So we have a series of a scatter plot here, different time periods when interest rates were at very different levels, and then the 5-year total return depending upon those starting yields. So as an investor, we do not want to buy bond funds or bonds when those starting yields are in the bottom left, when they are historically low. The upside return potential is somewhat capped. If we look at where we are today, the gray plus sign, the yield on Bond Fund of America, 4.2%. That higher level of yield gives us confidence that we will be able to generate higher returns as we move forward. Secondly, on the right-hand side, one of the critical roles that we believe bonds play in your portfolios is equity diversification, meaning they will simply act differently than the stocks that you own. In 2022, it was a tough year for investors. The Federal Reserve was aggressively increasing interest rates. As a result, bond prices were falling in unison as stocks were down 18% that year. The good news is we have seen a return to more normal correlations between stocks and bonds. Normally, if stocks aren't doing well, the bonds within your portfolio are helping to keep things afloat. If we go back to last spring with Liberation Day, the market peaked in February and then proceeded to fall 19% by the first week of April. So it was a pretty quick and dramatic fall in the equity markets. During that time period, bonds were up over 1.5%. So again, that more return to normalcy from a correlation. Think of bonds simply as being the airbag in your car. If you were designing a car for a loved one, airbags do not make your car go faster. They don't make the vehicle turn better, but they are critically important. And we think that's the role that bonds play inside of a well-diversified portfolio. Short-term bonds, in our opinion, offer some attractive opportunities for both yield and defense. There is a massive pile of money that has moved or shifted to cash and cash equivalents over the last few years as interest rates spiked. So think money market funds, CDs, ultra short investments. We believe that short-term bonds offer, again, attractive income and defense as they offer attractive yields. They have less sensitivity to a change in interest rates. But unlike a money market fund, if short-term interest rates continue to move lower, you will experience price appreciation, unlike a money market fund, which simply is a par investment, pays you a declining yield, but gives you zero opportunity for an increase in prices. And then finally, as we look across some of the areas within the fixed income markets, broadly speaking, again, yields are historically attractive. Here we illustrate current yields in blue compared to a 15-year average, which is that dark colored blue line. So as we look across the markets, many areas of the fixed income markets today give us opportunities to invest at attractive historical yields. And that's something the WDS team can help you as an investor navigate through, figure out what types of bonds based on your risk tolerance make sense. But again, the outlook on the fixed income markets continues to be strong. And then finally, one of the most favorite parts of the bond market for us at Capital Group today would be the tax-free municipal bond market. Two reasons why we continue to like municipal bonds. Number one is because the fundamentals in the muni market continue to be strong. With that being said, municipal bonds struggled on a relative basis in 2025. So the left-hand side illustrates time periods in which muni bonds underperformed taxable bonds. You will notice last year, muni bonds underperformed by 3.3%, which was the largest underperformance since calendar year 2010. So the royal blue bars are one-year returns when munis underperform. Your dark blue bars represent the following 2 years following that calendar year of underperformance. So history does not always repeat itself, but it does often rhyme. And if we go back and look at periods when muni bonds underperformed, they tend to outperform for the next 2 years. Again, fundamentals, in our opinion, continue to be strong. Valuations, again, continue to be cheap. And yield levels are very attractive. So on the right-hand side, one of the things you can always calculate is based on your tax bracket, where does it start making sense to invest in municipal bonds on an after-tax or tax equivalent yield? Traditionally, that break-even tax rate is somewhere in the mid-20s. Today, it is at a low level of just 16%. So investors in a lower income bracket, we believe, could still benefit from tax-free bonds based on where yields are today. So that kind of concludes some of the prepared thoughts Again, I said there was three things I was trying to accomplish. Then we can open it up to Q&A. I said number one, we wanted to give you some perspective on what Capital Group thinks about the year ahead. I tried to differentiate between perspective and predictions. Secondly, I said my goal was to give you some confidence, talk about some exciting areas of the market that we're optimistic about at Capital Group, and then finally shine a light on some opportunities. So I hope collectively I accomplished that, Lisa. Love to pass it to you and see what questions people might have.
Yeah, thank you so much, Dylan. So I do see in the chat, we have a couple questions. Dylan, is it fine if I read it out loud in case some people can't see the chat and we go from there?
That would be great, Lisa. Yeah, if you're counting on me to find and navigate the chat, that's probably a mistake in the first place. So if you can read them, that'd be super helpful.
Okay, we got teamwork here. So Julie is asking Dylan, how do the researchers get access to learn what is going on with the companies, the balance sheets, etc.? I'm naive to how this works. How do you assess that the researchers are able to vet and trust the info they walk away with?
Yeah, very, very good question. I think the question around access to companies and management teams is kind of a multi-layered answer. I think part of what helps us, in our opinion, get differentiated access to companies is through the size and scale of Capital Group as an investor. So we manage today just north of $3 trillion in assets. We are the largest shareholder of many companies in the world. An example of that would be Broadcom. We have owned Broadcom stock since they IPO'd or first went public. I think the fact that Capital Group is very much a long-term investor, not a short-term trader, helps with some of the relationships that we can build with management companies. Having Capital Group invest in a company is a positive indicator. So I think it's a number of factors. Again, I mentioned we have roughly 500 investment professionals that do north of 20,000 research visits a year. We also have some of the most tenured investment professionals in the industry. The average portfolio manager at Capital Group has more than 25 years of industry experience. So what that allows us to build is deep relationships with management teams over time. Again, we're a long-term investor, and I think the size and the scale of the organization allow us to get very good access to conduct those research meetings, to try to vet where we want to allocate on behalf of clients. So I hope that, Lisa, kind of helps address that question.
No, I think that was great. That was great. So another question from Jerry. A continued weakening dollar for 2026. What are the pros and or cons of a weakening dollar?
Yeah, from an investment standpoint, Jerry, there was a couple of things that I touched on. I mentioned the dollar weakened meaningfully in 2025. The benefit to the dollar weakening last year was it boosted the returns of your non-US investments. So roughly 50% of the returns that were generated by non-US stocks last year could simply be attributed to the fact that the dollar weakened relative to other currencies. So that was a pro. I'd say another pro that we saw in 2025 that was somewhat loosely related to the dollar weakening is we saw strong appreciation in some commodities like gold and silver. That was largely centered around policy uncertainty, a weakening of the dollar. So I think those were some of the pros that you saw. And again, our forecast is that the dollar is likely to continue to weaken this year, but not to the same extent that it did last year. And again, we view that as being a potential tailwind for non-US equities. And if we think back prior to 2025, the dollar continuously strengthened for an 11-year time period compared to other currencies, which then was a headwind to non-US investments. That was a big driver of why US equities or the best place to have money for the last 10 years. What we've seen is traditionally currencies will move in big, slow, long cycles. It isn't super uncommon to go through a prolonged period of currencies weakening or softening. And maybe we're at the beginning of a newer cycle, right, where the dollar on a relative basis continues to weaken.
Great, great. And so a question from Bonnie, which was partly answered from our great team here at WDS. The presentation materials were so informative. Are these slides or pages available through WDS or on the internet? And then our team here answered right away that there will be both a full recording as well as a recap available on our website at a later date. But Dylan, are these slides, are they approved? Can our
They
clients
are.
find them on your
Yeah,
website or someplace
they
else?
definitely are. So I would always encourage you to go through the WDS team. They can help get them to you. But yes, these are client approved. These are available on our public website. That website is capitalgroup.com. There is a search bar at the top right. If you click and type 2026 Outlook, this slide will pop up, or these slides will pop up. So the WDS team can get them to you, but they are available as well as other free insights that we publish at capitalgroup.com.
Perfect, perfect. I think that's all we see for questions. Again, thank you so much, Dylan, and everybody for joining today. We hope to see you at next month's event. We are featuring on February 25th at 6 o'clock a webinar covering cybersecurity. So if you'd like to attend this event, just sign up on our website. If you have any friends or family that you think might be interested in this topic, you are more than welcome to invite them to attend. We organize these events to bring value to our clients and community, and your referrals amplify our events' impact beyond WGS. So thanks again, everybody, for attending. Thank you so much, Dylan, for your time and your insight. And everybody have a great evening.